Good morning, and welcome to our latest update on the world of finance. Today, we're diving into the latest developments that could impact your wallet, your investments, and the broader European economy. On Friday, September 26, 2025, European stock markets experienced an unexpected surge, bouncing back after a tough day of losses that had left many investors feeling uneasy. Major indices like Germany's DAX, France's CAC 40, and the UK's FTSE 100 all posted impressive gains, signaling a renewed sense of optimism and confidence among investors across the continent. This positive shift suggests that, even in the face of ongoing economic challenges and global uncertainty, European companies are proving to be remarkably resilient and adaptable. The reasons behind this turnaround are complex. A blend of encouraging news from both Europe and the United States played a role in boosting market sentiment. Investors carefully weighed the latest updates on trade policies, fresh inflation data, and the ongoing fluctuations in oil prices, all of which have a direct impact on market performance. After considering the risks and rewards, many decided that the positives, such as signs of economic stability and potential growth, outweighed the negatives for now. This rebound isn't just good news for traders, it has real-world effects on pensions, personal savings, and the overall economic mood, encouraging businesses to invest and create new jobs. Understanding these market movements is crucial, not just for investors, but for anyone interested in predicting where the economy might be headed next. So, let's take a closer look at the details and uncover the stories and events that shaped this remarkable day in European markets. We'll begin by examining the unfolding drama across the Atlantic, where developments in the US often ripple through global markets. Stay tuned as we break down the biggest stories and key factors behind this unexpected market lift and what it could mean for you. It's a powerful reminder of just how unpredictable and exciting the world of financial markets can be. Now, let's turn our attention to a major piece of news that sent ripples across the globe. Late on Thursday, September 25th, the U.S. government announced significant new trade tariffs. These included a 100% tariff on imported medicines and hefty taxes on trucks and home fixtures. The announcement created urgency and uncertainty, especially for European and Asian companies. Despite the potential negative impact, European stocks rose as the announcement ended speculation, allowing companies to plan. Investors sought out companies that might benefit or be shielded from these new rules. It's a classic case of finding a silver lining in a cloudy sky. Let's dig deeper into these new U.S. tariffs, because the details reveal a complex web of economic strategy and global impact. While headlines often focus on the big numbers, the real story lies in how these tariffs ripple through industries, companies, and even the daily lives of consumers. The 100% tax on pharmaceuticals was a headline grabber, instantly doubling costs for European companies selling to the U.S. This move sent shockwaves through the pharmaceutical sector, raising concerns about drug prices, supply chains, and patient access. For many European firms, the U.S. is a crucial market, and such a steep tariff threatened to upend established business models overnight. However, the U.S. government included a significant exception. Companies that invest in building manufacturing plants on American soil could avoid the tariff. This offered a strategic choice: either absorb the cost and risk losing market share, or make a substantial investment in U.S. infrastructure to maintain access. This policy effectively incentivized European drug makers to pour resources into American facilities. While the upfront costs are high, the long-term benefits, continued market access, and potential tax breaks, made it a necessary move for many. It also signaled a shift in how global companies think about supply chains and local presence. Investors quickly identified which companies were already planning U.S. expansions, and those firms saw their stock prices hold steady or even rise. The market rewarded forward-thinking strategies and punished those caught off guard. Beyond pharmaceuticals, the new tariffs also targeted trucks and home goods, two sectors where European manufacturers have a strong presence. These industries now face higher costs and tough decisions about whether to pass those costs to consumers or absorb them to stay competitive. For American shoppers, these tariffs could mean higher prices on imported goods, potentially shifting consumer choices toward cheaper or domestically produced alternatives. Retailers and brands are already rethinking their sourcing and pricing strategies in response. The market's reaction was nuanced. Rather than a broad sell-off, investors favored companies less exposed to U.S. tariffs, especially those with diversified supply chains or a strong U.S. presence. Instead of panic, there was a calculated response. Investors rewarded those best insulated from the tariff storm, while companies slow to adapt faced skepticism and downward pressure on their shares. This strategic shift highlighted the growing importance of having a U.S. presence for European companies. It's no longer just about exporting goods, it's about being part of the American economy to weather policy changes. The market's confidence in well-prepared companies helped stabilize European stocks, even as uncertainty lingered. Those with robust contingency plans and flexible operations emerged as leaders. It was a day of re-evaluation, not collapse for the sector. Analysts and investors took a closer look at balance sheets, supply chains, and long-term strategies. In the end, investors bet on resilience and adaptability in the face of new trade challenges, knowing that those who can pivot quickly are best positioned to thrive in an ever-changing global market. The 100% tariff on medicines is a high-stakes issue, sending shockwaves through the global pharmaceutical industry. For patients, it raises concerns about access and affordability, while for companies, it's a test of strategy and resilience. The U.S. is the largest market for pharmaceuticals, crucial for European drug makers who rely on American demand to drive growth and innovation. Billions of dollars in revenue and thousands of jobs are at stake. This tariff threatened to disrupt a $212 billion import market, potentially causing delays, shortages, and price hikes for essential medicines. Companies like Roche and AstraZeneca faced uncertainty about whether to absorb the extra costs, pass them on to consumers, or even consider pulling out of the U.S. market altogether, a move that could have global repercussions. However, the exemption for U.S. manufacturing investments turned the situation into a strategic challenge, encouraging companies to rethink their supply chains and production footprints. Investors rewarded companies already investing in U.S. facilities, seeing them as better positioned to weather the storm and capitalize on new opportunities. The market quickly distinguished between prepared and unprepared companies, separating those with foresight from those caught off guard. The broader European stock market's positive movement suggested confidence in the sector's resilience and adaptability, even in the face of such a dramatic policy shift. Companies might need to invest in U.S. factories, but they're seen as capable of adapting, leveraging their global expertise to navigate new regulations and maintain their competitive edge. The tariff announcement led to strategic reevaluation, not sector-wide collapse. Instead, it sparked innovation and a renewed focus on long-term planning. Investors focused on companies with foresight and adaptability, rewarding those who could pivot quickly and turn challenges into opportunities. The market's response was a bet on resilience in a complex trade landscape, highlighting the importance of agility in a rapidly changing world. European companies are seen as capable of navigating this new reality, turning a bitter pill into a catalyst for transformation and growth. Let's switch gears to another key factor, inflation. The U.S. Personal Consumption Expenditures (PCE) price index, a key inflation measure, showed stability. Core PCE rose 2.9% year-over-year, matching predictions and calming markets. The steady report suggested inflation wasn't out of control, reassuring investors. Predictability in economic data is prized, reducing uncertainty. The stable PCE report indicated the Federal Reserve's policies might be working. This calm reading on inflation provided a stable backdrop for the day. It allowed investors to focus on other news, like tariffs, without inflation worries. The steady inflation data contributed to the positive market mood. Why does the PCE price index matter so much? It influences the U.S. Federal Reserve's decisions on interest rates. Stable inflation means the Fed is less likely to raise rates aggressively. Lower rates are good for stocks, making borrowing cheaper and boosting profits. The stable PCE numbers reassured investors, signaling a friendly financial environment. For European companies, a stable U.S. economy is crucial for business. The PCE data offset tariff anxiety, boosting European stocks. It was a key reason for investor confidence and market gains. Another factor stirring the pot was rising oil prices. Oil prices surged, with Brent crude above $70 a barrel. Supply concerns, especially from Russia, drove prices higher. Drone strikes on Russian facilities disrupted supply, tightening the market. Russia's export curbs on diesel and gasoline added to the pressure. Higher oil prices can signal strong demand but also act as a consumer tax. Energy companies benefited, boosting their stocks and lifting markets. The market focused on the positive aspects, like energy sector strength. Higher oil prices are a double-edged sword, impacting various industries. For now, the market chose to focus on strong demand signals. Investors will watch if high prices start to drag on growth. The energy sector's performance was a key driver of market gains. Rising oil prices weren't just about supply issues in Russia. U.S. data showed stronger than expected demand, with falling crude inventories. This signaled robust demand in the world's largest economy. The combination of tight supply and strong demand pushed prices higher. European energy companies like Shell and BP saw stock gains. Energy sector strength helped lift the entire market. High oil prices benefit producers but increase costs for other industries. The market focused on strong demand and energy stock boosts. Investors will watch if high prices impact economic growth. For now, the market embraced the positive demand signal. Amidst international news, Europe had its own bright spots. Spain's GDP growth exceeded expectations, signaling economic resilience. This positive data boosted confidence across the Eurozone. Investors anticipated more good news from Italy's confidence numbers. The U.S. inflation data calmed fears of aggressive rate hikes. Tariffs were seen as navigable for well-prepared European companies. Rising oil prices boosted the energy sector, lifting markets. Positive domestic data showed Europe's economic health. Investors will watch how these stories develop in the coming weeks. For one day, optimism outweighed worries, lifting European markets.